Hey, what's up? Welcome back to Chalk Talks with Coach B. All right, here's a question I get all the time. You've got $500 to put to work. Do you buy the stock outright or do you buy a call option on that same stock? And people think the answer is obvious, but it's not because they can end up in very different places from that exact same starting point. So today we're going to run them head to head. Same $500, same stock, same time window, and we're going to see exactly how it plays out. If you're brand new to options, go check out the Options Basics playlist first. I'll link it in the description because today we're getting a little more hands-on with the math. All right, let's get into it. Here's the core idea in one sentence. Buying shares means you own the stock, and buying a call option means you control it. And those are two very different things when the price moves. So let's set up our example. We've got a stock trading at $70 a share. With $500, you can buy about 7 shares. That's $490 in stock, a little change left over. Now on the other side, instead of buying shares, you buy one call option, a contract that controls 100 shares, and let's say the premium on a 45-day call at the 72.50 strike is $5 a share. Since options trade in 100-share contracts, that's $500 total for one contract. Same budget, same starting point. Now, and this is the key thing I want you to understand, that call option gives you the right to buy 100 shares of this stock at 72.50. You don't own the shares yet, you just have the right, and for that right, you paid $500. That's it. That's your maximum loss right there. $500, not a dollar more. With the shares, you own them. If they go to zero, you lose $490. If they go up, you make money, but there's no expiration date. You can hold forever. The option, it has a clock ticking on it from day one. That's the trade-off. That clock is called theta, time decay. Every single day that passes, your option loses a little value just from time running out. The stock doesn't have that problem. It just sits there. So if the stock goes sideways and does absolutely nothing for 45 days, your shares are basically where they started. But your call option, it's worth less than you paid for it. Maybe a lot less. That's the cost of leverage. All right, so let's run the 3 scenarios. Up 20%, down 20%, and flat. Scenario 1, the stock goes up 20% from $70 to $84. Your 7 shares are now worth $588. You made about $98, roughly a 20% gain. Not bad at all. Now your call option. The stock is at 84. Your strike is 72.50. That option is now worth $11.50 of intrinsic value times 100 shares. That's $1,150. You paid $500, so your profit is $650 on the same $500 starting budget. That's 130% return versus 20% on the shares. Same $500, same stock, same price move. The option returned over 6 times more. That's leverage. Scenario 2, the stock drops 20% down to $56. Your 7 shares are now worth $392. You lost about $98, same 20% down. That hurts, but you still own the shares. The stock could recover. You're still in the game. Your call option, the stock never hit 72.50. The option expires worthless. You lose the entire $500, every dollar of it, gone. That is the defined risk of a long call. It's brutal when it happens, and it absolutely happens. The shares at least gave you something back. The option gave you zero. This is the downside of leverage cutting both ways. More upside, yes, but also the very real possibility of losing everything you put in. 100% loss, not down 20%. Zero. Scenario 3, the stock goes nowhere. Your shares are basically flat. You're roughly where you started, maybe up or down a couple dollars. No big deal. Your option, even though the stock didn't drop, theta has been eating it alive. If the stock is still sitting right around 70 with a week or two left on the clock, that option might be worth $1, maybe 2. You could be down 80% of your $500, even though you were basically right about direction. You just didn't get there fast enough. So let's zoom out and look at all 3 scenarios together. The option wins big when you're right, and the move happens fast. It destroys you when you're wrong or even when you're right, but the stock moves too slowly. Here's the mindset piece, and this is what I really want you to take away. The option isn't inherently better or worse than the stock. It's a different tool for a different job. If you have strong conviction that a stock is going to move significantly in the next few weeks, not months, weeks, and you want to put a defined, limited amount of capital at risk for a much bigger potential return, a call option can make a lot of sense. If you want to own the stock long term and you're not sure exactly when it's going to move, shares are almost certainly the better answer. You can hold forever. Options have an expiration. One more thing, and people get this backwards. Options traders like to say their risk is defined because the most they can lose is the premium. And that's true. But losing $500 on a $500 position is a 100% loss. Losing $98 on a $500 position is a 20% loss. Which one hurt more? Think about that before you trade. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. All right, that's it for today. If this clicked for you, hit that like, subscribe, and drop me a comment. Tell me which side you're on, shares or options. I read everyone. Good luck in the markets, no matter what stock you're into.